Welcome to the Free from Wall Street podcast, where we share how we have done over $200 million in real estate deals to create, preserve, and pass on generational wealth without the roller coaster ride of the stock market. If you're ready to start investing with purpose, visit freefromwallstreet.com. But for now, let's dive into this episode. All right, welcome back to the Free from Wall Street podcast. Thanks for tuning in. As always, we appreciate you. Want to touch on a couple of things that we've been talking with some investors about that the comments keep coming up. I thought maybe it would be helpful to talk about this. So a question we keep getting is, why would we exit a property before the time horizon that was expected when we bought the property? Right? So if we tell you that it's going to be a 5-year hold, why would we exit in 18 months or 24 months or something much earlier than that? So let's talk a little bit about our 3 core tenets when it comes to why we do what we do. 1, preservation of capital. How do you not lose money? Right? So preservation of capital is number 1. If there's volatility on the horizon, or we think that we can achieve the same returns, or if we see that we can preserve capital better with that strategy, that's our number 1 concern, right? We don't want to have volatility in the investment amount, the initial investment amount. So, number 1, preservation of capital. How do you not lose money? Number 2, return of capital. How do I get my money back out of an investment? So, you can sell a property, you can refinance a property. There's different things that you can do to mitigate your downside risk when you have to get your money back out, right? So we like to have multiple exit plans and strategies to make sure that we can get our money back out. And when I say ours, I mean you as the investor and me as a co-investor. Number 3 is return on investment. So how do I make sure that I'm achieving the annualized return that we're projecting? Okay, so it's in that order, right? We don't mess around with the order of things. So number 1, preservation of capital. Number 2, return of capital. How do we get my money back? And number 3, return on investment. The return on investment is in the number 3 spot because you don't care what your ROI is if you lose money. You don't care what your ROI is or potential ROI is if you can't realize those gains, right? So pretty simple, but important to understand that that's how we look at our strategy. In that order. Now, why would it come to pass that we can get money back out of a deal, but we would want to do that instead of keeping it in there, right? Maybe we can make more money if we kept the money in the deal longer. Sure, that's possible, right? And if I was looking at number 3 first, then that is what we would do, but I'm not. I'm looking at number 1 first, right? And that's preservation of capital. So, give you an example. Purchase a property, we expect it over time to increase through cash flow and through back-end appreciation to where we get a total return, right? So there's 2 ways that we're paying out the investor, which is through cash flow and then also appreciation. Well, typically these deals take 3, 4, 5, up to 7 years to appreciate long enough to hit those projected returns, right? So I have to hold it for, let's say, 5 years to achieve a 10 or a 12% or whatever the return is for that particular deal per annum, right? So per year. So I'm more concerned about how do I make sure that I don't lose money? And number 2, the time value of money. So if I can hit pro forma numbers that are achieving the same type of return on investment in 12 or 18 or 24 months that we're projecting would take 5, 6, or 7 years, then that's a good thing, right? That means that we've done our job to where we can not only just pay the cash flow, but that accrued appreciation much faster. And usually it takes time to do that. We have to appreciate the property with increase in rents, decrease the expenses, and get that value creation done over time. Now, typically it takes time to do that. If you can do it faster and recycle that capital and compound that capital faster, then that's what we would want to do, right? That's what I want to do for my family's money. That's what I would hope that the investors would like to do as well. Now, couple of inherent problems, right? Most people give us capital because they don't want to deal with the in and out, right? They want to set it and forget it, and I get that. But Our job as money managers is to take that into consideration, but also make sure that we are saving the capital and increasing its efficiency. So efficiency of capital is one of these things that we don't talk about a ton, but the more times you can turn that, right, compound interest being the eighth wonder of the world, the more times that we can compound that 10 or 12 or 14% return, the better off we will be over time, right? So even though it's a little bit of a hassle to get your money back and have to redeploy it into our next project or into our next fund, it's better for the money, right? And that's what we're always looking at: preservation of capital, return on investment, and how do we make it more efficient and more effective for all of us. So that's why we would recycle that capital faster. There's some times where maybe it doesn't make sense. Maybe by selling it a little early doesn't make sense for the return on investment, but it makes sense for the preservation of capital. Maybe it makes sense for the return of capital, but not the return on investment, right? And as money managers, that's what we have to look at in every situation. So hopefully that's helpful, because we're just looking to make it short and sweet and why we would do something like that. Now, there's other deals that we're going to hold for 5, 6, 7 years, and that's perfectly acceptable. The market has given us an opportunity over the last couple of years to capitalize on a lot of capital coming into the multifamily space, so we are achieving some of those returns faster than we were able to. And if you think about it this way, let's say you have a $100,000 investment, and let's say you're gonna be looking to make 12% per annum, right? And we hold the property for 18 months or so. Would it be better to make that 12% per annum over the next 5 years with maybe some inflationary issues, maybe some interest rate issues, or do we take that money, capitalize on it, and roll it into a new project and compound that money faster and give us some more diversification? And for me, I always think, well, how long would it take to get there? And some projects will take 5 years, but if you can get there in 12 or 18 months and increase that value of that property by 12 or 15 or 20% in that short period of time, best thing to do, capitalize, move on to the next project. And so it was a question that came up a few times with a couple of investors. I think, frankly, it was because they were more concerned about how to redeploy that capital. Luckily, we told them about our fund, and we have some other projects and things coming up, so they were okay with it. But it did come up, and that's the only reason. It's not a long-winded answer. It is preservation of capital, return on investment in that order. And if we have the opportunity to capitalize while that deal is still in its infancy, we will do so. So thanks for listening to the Free from Wall Street podcast. Could you share this if you're finding value from it? Would you invite somebody to subscribe, to leave us a rating? Appreciate you guys. Thanks for listening to the Free from Wall Street podcast. If you like what you hear, leave us a rating and review and let us know what you think.